would like to welcome everyone to the channel for the Credit Union channel. I'm Ranjit Etiarachi from Asian Confederation of Credit Union. Yesterday, I did one video in my own language, Sinhala language, for the Sri Lankans, my fellows, to understand and uh, read and understand the balance sheet as well as liquidity management. Many people request for me to do in English for the benefit of other people. Let's have a three objective of this one in simple way to understand the balance sheet, loss and profit account, what is the profitability of the your cooperative in the balance sheet, what is the assets and liability compositions, one area, and third area, how it is assets and liability segregation, how it's able to manage, which will lead to the assets and liability management. So I will go later on one by one. Before that, I will go to explain what is the basically our credit union vision statement. Everybody understand the credit union vision statement in the federation level. They're looking for sustainable integrated network. That meaning I will explaining to you later on what is the meaning sustainably, but I will not going to explain about sustainability matter. In the primary level, also use the sustainable and viable. There are two words, sustainable and viable, and respond to the members' need. I think there are three major focus on primary. It has to be sustainable. It means we need continue. Financially, it should be viable for the physical every fiscal year. If you are not managing physically year one by one in the viable, so it will lead to the sustainability issues. And more important, respond to the member needs. I think I have not going to explain on this matter. Then I will go to the balance sheet. See, but before that, let me go back to the mission statement. Mission statement is very important in the federation level, second tier, to ensure sustainable growth of the credit union. I think that's what very important. Federation uh, cannot to make any excuses saying that our federation is a training and education. We don't have any control to manage your primary society, so they are independent autonomous. I don't think that's reasonable. You have to find the role of the federation to ensure sustainable growth of the credit union, enabling them to provide quality financial services to improve the life of you. I think this is a very, very important elements. National federation, or you have a three-tier system, a secondary, they have a responsibility. It cannot be just like a training arm or just like just association or affiliation. They have a main responsibility, ensure their primary members society are providing quality services which lead to improve of the people's life. The primary society definitely providing the quality financial services. I can go to later on to measuring your cooperative society whether it's providing quality financial services, but looking the balance sheet. I will take one example from the Nepal. That's not the best one, but anyway, I will take it. In my experience in the Asian context, it's not the largest, it's not the smallest. The in the average size, to be sustainable, you need to have a business volume, you have to growth rate, membership around maybe 300 members, and the asset size is of 500,000 US dollars. It could be calculated your own local currency, and the portfolio, loan portfolio quality, loan portfolio 400,000, and staff number 8, and the growth rate for the assets growth annually is a 15%, membership growth on 10%. I think this is type of, maybe you have a lot of questions. We are village, we are so small, we have a different geographical situation. You might have a thousands issues. But I respect all, but we have to find, in order to be a sustainable financial cooperative society. So that is why you can see, if you look at my previous video in the US and other countries, they go for amalgamation. I don't have much time to go deviate it. So now they are consolidating, because this is market economy. The credit union do not have an exclusive financial the market. So you have to compete. So this is how do I try to make you understand. Let's get this a fairly good one. So this is income from the loan. That means interest earned from the cooperative society from their portfolio. So it's a very, let's forget about the numbers. It's 11 million. 89% source of income is coming from the main core business. Core business is providing financial services. I think that's a very important. It's not depositing the money in the bank, or not real estate, or maybe hotel or anything. No. So core business is 89%, but they also have a income from the financial investment 2.4, and another one income from the non-financial investment from there. This is a type of the other type of stationery or smaller things. It's not the big issue at all. So then the other income 100%. It's very, very fairly good. I think this is how able to, whenever you are preparing your, particularly in our credit union managers, trying to look at your source of income. So then you will able to see what is really your core business. Let's go to that the expenditure side. And sorry, it's at my local language. No problem. That's okay. The financial cost. That means you lend this money. Definitely, you cannot lend all the money you mobilize from the deposit or share or your institutional capital. You have to keep certain percent liquidity, and then just a non-earning asset also. But fairly, the cost of that, it is only 5.4 million, and it's almost like 42%. Fairly good market. This will tell him that you are not, credit union are not how do I say, artificial interest rate offering for the depositors. This is very important. They're following fairly, but little bit, maybe some margin is given better than other financial institution to be a competitive. And also they charge interest, and their administrative costs are fairly 25%. So we compare with the total expenses, they give it, it's included staff salary and governance costs and everything. And then more important, they have make a provisions. I will go later on 15%. Now you can see very important loan losses provision. That means the uh, possible losses. If you are not making possible losses for the during these fiscal years, you can show it double your profit margins double, and then you will able to make it a better dividend and giving the another patronage return. You're saying we are doing, but you are not appropriate, proportionate. You are not managing risk. I think I like to see all the accountants and all the bookkeepers, when they are preparing, kindly prepare this type of the summary. You might have a detailed account, kindly make it a summary, like a really our financial source of income directly for business and other investment costs. So there are four items, and your expenditure side only three items. Very clearly, our board and other, even the members. If you put it this your notice board, if you publish your uh, news item, that people can read it and understand it. If you put it at least around maybe 3 years consecutive, now you can see our institutions are growing. If you are putting that every month, okay, this year and the last year, and particularly accumulated, Now you can see member education. So member will trust. So what is the benefit? If the member can trust, member will bring more money. I think that's very important, as that's your job to educate your members about the financial institution. I will move to the more important part, the balance sheet. Many people are saying, I do not know accounting. I am not an accountant. You don't need to be an accountant to read and understand the figures. As long as you can read and figure, if you understand the balance sheet. The balance sheet, there are two components. One is assets, one is liability. When is the liability, there are two components, and liability and equity. Asset, we have a liquidity asset, our main business loan outstanding. Another one is a financial investment and non-earning asset. So altogether, you can see 100% here. The here, when we look at here, the balance sheet, the biggest ratio is coming to here. Loan outstanding is a balance is a 86%. But when you look at the current balance quality after after reviewing portfolio delinquency level, when we segregate it, we'll have it. Liquidity position, cash in hand, cash in bank, and everything, only 9.5. So it's a very important to 9.5. And then it's a loan outstanding 82%. It's quite fairly good, little bit above the average. It should be 80%, maximum 70 to 80%, but it's little higher. But it's good to maintain that level. Very important to look at their portfolio. I will tell later on. So then we have to look at here is the most important part, the segregation, and then it's important all together. There's no any loan is a restructured. That means that change the agreement. There's a no, and then mispayment 1 day to the 12 month. It's around maybe 5 million. It's a 3.2, and over 12 month it's only zero point 0.1. And then the doubtful provisions for the current loan, they make it around zero point 0.4, and altogether loan outstanding 86%, but current only 82%. It's very good. And here, non-financial investment is a financial investment, very, very insignificant. That means they have used the total, the funding to the our lending process. Non-earning asset, it's here 2.5, and here the total non-earning asset is a 3.4. I think fairly very good balance sheet. Let's see where the liability side. It's very important. The liability side also we can look at around four level: member deposit 71%, and non-interest bearing variable. That means the based on the running the business, some has to pay for the current liability within the 30 days time we have to pay. So these are the things. And external borrowing, the here loan 11%. That's big, big 11%, but when we compare with that, not too bad. But total liability 83%. Share is at 14 million, that 8.8. It's below the standard. Minimum should be 10%. And another one, it is a general reserve fund, is a 4.8. And then you can see that the transitional capital and total together around 16.8. So this is how the balance assets and liability balance sheet position is a very important for people to understand. So in this segment, this credit union, a fairly good deposit has mobilized and only 11%. But if you look at for the last 3 years consecutive 3 years trend, we can make a better decision. But come back to my main question, sustainability. So I think I like to summarize with the sustainability. It's a minimum 1,000 members, three staff, 100,000 US dollars financial structure. So this is the asset size, the liquidity around 15%, and the loan around maybe total loan 80%, non-earning asset 5%. Deposit it's at 75% to 80%, that's good. And external loan, okay, less than 5%. Share capital should be at least 15%. Sorry for my at least 10 to 20, but at least 15. Institutional capital minimum 10%. This is a very important another element of this slide. Our assets and liability reconciliation. When you say savings withdrawable, it's a 28%. Time deposit is a 28% or less than 1 year. Over 1 year, only 16%. This is how our deposit side. And then you look at the loan portfolio. So less than 12 month of micro business loan, and that also SME loan. That together same can consider. And this organization has a development loan or 24 month to around maybe 36 month, only 16%. I think this is very important. Every credit union, based on your structure, they have to look at how they can managing the assets and liability, and then see this is how the credit union buildings and structure. I hope that when you maintaining your assets and liability, that position, that credit union is the most strongest, friendly, and healthy, viable, sustainable financial institution. If you have any questions, concern, please let us know. We will able to answer your question. Thank you so much once again joining to today session. Thank you.